Interest rates are set to rise by December, economists predict. My name is Charles Kelly. I'm the author of the book, Yes, Money Can Buy You Happiness. And I've also run these podcasts, which now come to over 250 episodes. I help people with money issues and coaching and so on. Now, what I want to talk about this evening is what I've been going on about for the last few weeks, and that is rising inflation and rising prices. Prices are going through the roof for energy, for food, for fuel, oil at $84 a barrel. Natural gas prices in the UK have quadrupled, and now this is leading to higher inflation. We already had higher inflation due to just costs going up after the end of the lockdown. Everything's just seemed to go up. Food's gone up, just everything. So this is causing higher inflation, and now we have the markets, the economists in the markets predicting and pricing in an interest rate rise before Christmas. The Times reports today that the economists at the Bank of America in London expect a modest, well, it's a 0.15% percentage point rise by December. That will take base rates up to 0.25%, and it's base rate lending rates have not actually increased since 2018. They went down in March of last year during the lockdown and the pandemic, and they went down to an historical 0.1%. I think they were followed by similar kind of rates in America as well. So we've had very, very low interest rates, which is not great for savers, to be fair. You know, they're getting very low rates on their money. Now, if you're earning next to nothing on your money, but then you've got 4% inflation, that means it's eating away at your money each year. You're losing 4% of the buying power of your money with almost zero return if you're sitting just there in cash. Now, the central banks are a little bit between the rock and a hard place when it comes to raising rates. They need to raise rates to curb inflation. Inflation is expected to reach 5 and 6% by the end of this year. And America, if it counted inflation properly, it would already be over 5%. And some even say higher than that. So they've got to do something to curb inflation, and the way they usually do it is by raising interest rates. That slows the economy down. But the economy is not really motoring forward. It's just that prices are going up due to various shortages and so on. But if they do increase rates, the central banks and the countries in America, in the UK, and Europe will have to pay billions more in interest on the money that they owe as well to bondholders and all sorts of other institutions. So they're damned if they do and damned if they don't. It will cost the UK, like a 1% rise in interest rates would cost the UK 10 billion a year. That's just 10 billion just gone like that. And in America, it would be even more on their humongous multi-trillion-dollar debt. I think it's certainly over 30 trillion. So that's the situation they're in. Unlike in a booming economy, you expect inflation to rise, but this is not really a booming economy. Yes, it's going up because it started from a low point where there was a big downturn last year. So what is causing this? Well, fuel is one thing, oil and gas is going up, but also it's just the shortage of goods, the shortage of staff, and just generally things are just going up. A lot of our stuff is imported from China, and even just after the pandemic, we knew that shipping costs had gone up, had risen sharply. So that is immediately going to add to the cost of everything. So it's not looking good, and you could have a situation where you've got higher inflation but low growth, and that's usually called stagflation, which Japan had after their boom ended in the end of the 80s, and they've never really recovered from it. Now, as far as interest rates are concerned, apart from investors, they're looking at interest. They'd like interest rates to go up, but homeowners and buy-to-let mortgage holders will probably be not so happy because most people who own a home, especially young people, would have a mortgage on that home. They'll not be so happy, but in the UK, we expect most of those will be protected for the time being whilst they're in a fixed rate mortgage, but they will suffer higher repayments once these deals expire. And usually in the UK, most fixed rates are fixed for only sort of 2 to 5 years, maybe a bit longer. I know in America, a lot of mortgage rates are fixed for longer, 10, 20 years. But in the UK, the longer you fix it for, the higher the rate is. So if you'd fixed your rate, a few years ago for 10%, for 10 years, you'd have probably been paying 4 or 5%. Whereas, you'd be losing out big time because rates have been so low. And I'm thinking, the choice comes when you come to renew these rates. You say, well, look, if I go for a 2-year deal, it's maybe, I don't know, I'm just guessing here, say 1.5% to 2%. But if I go for a 5-year deal, it maybe is 3% plus. And so you're thinking, well, what should I do? Because rates could go up. If I take a 2-year deal, then in another 2 years, I've got to make another decision. Rates could be higher then. So on my stuff, I said I'll go for a 5-year deal because I didn't want to go through this 2-year churn every time. And then at the end of 2 years, you have to make another decision. You have to pay another fee to fix your rate. And actually at the last round of renewal, rates had actually gone up. Even though the base rates were historically low, almost zero, the lenders were charging more to their mortgage holders when they come to get a new fixed rate deal. And in fact, there wasn't much choice there. I had to take a higher rate. My payments on one of my mortgages doubled from what it was before. And this is at the time when you had historically low rates. And since then, rates have remained low. And it all seems to happen with the fixed rate. The longer I fix a rate for, the more interest rates go down. But there you go. At least with a fixed rate, you've got some security there. So that's going to be interesting if we start seeing rates creep up. And economists are saying that, rates will go up by a small amount in December, but there could be further rate rises next year. So if we start seeing rates rise and people are coming to the end of a fixed year, 2 or 3 year deal where they've had a very low rate in the past, then they could suddenly see a big hike in their mortgage repayments, and that's not good for them. Now, cheap borrowing, of course, has been blamed as one of the reasons for increase in soaring house prices, which have put houses beyond a lot of people's reach, especially first-time buyers. And this is despite the country experiencing the worst recession, the worst economic downturn on record, and yet house prices have continued to soar. It's partly due to other reasons. There are a lot of reasons for it. There's a shortage of houses in the right areas. There's plenty of land in the UK, but you can't build on most of it. I think only about 2 or 3% of the land in the UK has been developed. The rest of it is green fields. And I'm talking about developed in terms of houses and buildings and roads. Most of the land, if you drive outside the big cities, you'll see countryside everywhere. Big parks, national parks, loads of green. A lot of it's called the green belt. You can't develop on it. A lot of it is called farmland, of course. You don't want to just build over every bit of farmland. But, there is a belt called the green belt, which goes around most big cities. And all the building that goes on mostly goes on inside that powder keg, that pressure cooker inside the green belt, where land becomes more and more expensive because you can't build outside of that ring that goes around it. And that creates huge pressures on land costs. The cost of building a house is not the main thing. You can build a house for £50,000, maybe £100,000. So why do you need to pay £1 million for that same house, or £600,000 or £700,000 for that same house? Well, it's the cost of the land, and that's the way it is. But over the years, we've had quite low interest rates. Even before this record low interest rates, we've had low interest rates since 2008, when we had the last downturn. And the government's brought rates down. They wanted to pump money into the economy. They've been printing money ever since. So obviously asset prices with all this money printing have continued to rise. Interest rates are low. You can borrow money so cheaply. I remember about 5 or 6 years, no, maybe longer, 5, 6, 7 years ago, I was able to borrow more money and buy another property with that money. And my repayments went down. I think on one particular mortgage, I was paying £1,000 a month. I was able to borrow another 100,000, remortgage it, borrow another 100,000 on interest only, and my payments went down to £250 a month. And I used that 100,000 to buy another property, which gave me then income, and it's still giving me income today. So it almost made sense to keep borrowing money to buy, because the money is just so cheap. And why would you have your money sitting in the bank when you can borrow and buy assets that then produce income. Now, it worked out for me then. You can go too far with it. You can over leverage yourself and then get caught if there is a downturn, and lenders can start calling in loans if the values of the properties are seen to go down too near to what you owe on the properties. That happened to people after the last credit crunch, when lenders started calling in mortgages where they felt that the loan to values were getting too high, or the values of the property were nearing what was outstanding on the loans. A lot of people got caught by that, and it caused big problems for them. It's never happened to me, but it can happen. Lenders can call in mortgages. When I say call in, they can just demand their money back, just like that. It's in your mortgage terms if you read them. So cheap borrowing is still around. It looks like it will still be around, but rates will start to creep up. So just be careful there. And if rates creep up, then that should slow things down. And normally when you get much higher interest rates, that normally creates a bursting of the bubble in the property market. Property markets love periods of low interest rates. It doesn't always happen like that. I've been in a property bubble where interest rates were very high. But if rates continue to go up, you would expect property as an asset class, as a buy-to-let class, to suffer. And of course, we've got all this anti-buy-to-let sentiment going on across the country from, the public and the left wing of politics, the Labour Party, saying we all these rich landlords and this sort of stuff, and of course the government have brought in rules to make life more difficult for buy-to-let landlords. They've taken away tax benefits from them, and it's not been good, but it's still a fairly profitable business. And for people investing in pensions, many millions of people have put their money into property where they can use leverage to borrow to buy property rather than put their money into pension schemes. That's just a fact. Right, so at the moment there are 1.1 million job vacancies in the UK. They've reached a 20-year record high, and that will in turn slow down economic recovery, because how can companies expand? How can they do more business if they're short of staff? And yes, this includes mostly hospitality. It includes some engineering, some mechanical work, and farm work as well, and of course lorry drivers that we've all read about. But a business can't expand if it doesn't have the people. So a haulage firm is losing business because it's got lorries sitting there with no one to drive them, and we've even got the port of Felixstowe backed up with containers because they haven't got enough drivers to get them out and get them delivered to their customers. So eventually they might have to start turning ships away. So a staff shortage is not good for business. Now suddenly this staff shortage seems to have come out of nowhere, because it's not just in the UK, so you can't just blame Brexit, but it's also in parts of Europe, in Germany, and in America, and in France. So where this has sort of suddenly popped up from, who knows? I'd have to really study into that and see what the situation exactly is with that. But the ONS reports that the number of employees on payrolls, these are now employed people earning salaries, showed another monthly increase, rising 207,000 to a record 29.2 million in September. So that's another record number of people in employment. So that should be good news for the economy in that respect. And the Institute for Employment Studies, the IES, said labour shortages were affecting the whole economy, and were likely, between a quarter and a third is explained by lower migration. So they're saying that if people can't come into the country and fill those jobs, then it will affect the economy in the long run. And they're saying a third of it is down to lower migration. Well, obviously after Brexit, we've had the end of free movement of labour in terms of the UK. We had that before, where people could just come into the country without any visas from any European Union state and work and do what they wanted and claim benefits in some cases. But with that ending, that was obviously going to create some sort of squeeze on employment. And I think the timing was so bad with the lockdown, because a lot of people from Eastern Europe went home during the lockdown because there was no work, especially those working in hospitality and those kind of jobs, just said, well, I'm going home to sit it out. And maybe some of those people haven't come back. Maybe they've got jobs in their own country or in Germany or other countries. I don't know. But Tony Wilson, the director of the IES, told the BBC that were now fewer unemployed people per vacancy than any time in the last 40 years. Wow, any time in the last 40 years. So that's going back to the 80s. And this is down to fewer older people in work and more young people in education. Well, there you go. It was a policy of the Blair government to get more people into university. They wanted 50 or more % of people to go to university. Many feel that a lot of these people would be better off going into vocational studies, which is directly related to jobs, rather than, say, doing something like, I don't know, philosophy or ancient history at university. Sorry if you're a philosophy student or an ancient history student, but I'm just trying to give that extreme example. Whereas a young guy I know, he didn't go to university. He went straight into an apprenticeship to become a surveyor. And he's on his way to gain into professional qualifications as a chartered surveyor. And he, during his time in his apprenticeship, he's been able to buy a property with a bit of parental help, but he's got a mortgage and he's well on his way. If he was at university, he'd probably just be leaving now with a huge debt of £30,000 around his neck. So but going to university is not the be-all and end-all. And if you want to go to university, you should be able to. It's a great thing. But I think the figures explain it here, that more people are in education and can't work. Whereas if they're in vocational courses, they'd be combining work with their studies, such as apprenticeships. So that's another statistic. And the number of vacancies, as I said, hit 1.1 million, and average weekly earnings, including bonuses, are now pushing higher and higher. They've reached 7.2%, higher than this time last year. And wage rises, which actually have, in some sectors, have gone 15 to 20% higher. And we've got farm workers being paid £1,000 a week to pick crops. It's 15 to 20% higher in some sectors. And that automatically usually leads to higher inflation, because if the employer has to pay 15% more on their staff cost, where are they going to find that extra money? They have to put it on the prices. And it's just common sense, isn't it? I was at my local fish and chip shop, the famous English dish, recently. I always talk to the owner and have a little chat with him. And he said, oil's gone up, cooking oil, electricity, gas is going up, and staff costs are going up. He's struggling to find staff. Food prices, the fish, the potatoes, everything is going up. And he said, my prices will have to go up very soon. He's trying to hold his prices down. He's trying to sort of reduce portions a little bit, which is fine. But eventually his prices will inevitably have to go up. That's just one example of a small business selling fish and chips. What about the big businesses that are having to pay lorry drivers now £70,000 a year to drive a truck? How are they going to do this without putting up prices? So wages, and I've seen this in the 70s. A lot of young people might say now, oh, inflation, what are you worried about inflation for? What is inflation anyway? What's that all about? Well, I've lived through inflation in the 20%. I've seen unions go on strike for higher pay claims when they wanted a 25% wage rise. A 25% wage rise. I can't remember whether it was the dustmen who went on strike. The miners were always asking for that sort of money. The rail workers, they all had powerful unions. And in fact, it's almost reminiscent of the 70s, because in Brighton, the unions have had their dustmen on strike for the last couple of weeks, and rubbish is piling up in the streets of Brighton with rats jumping through all the plastic sacks of rubbish on the streets, which very much reminds me of the 70s when they had that long strike and the winter of discontent, and there's national strikes going on for months and months, and rubbish was piling up in Leicester Square in London, like 20-foot high pile of rubbish. So it's almost like the replay of the 70s. Higher inflation, higher wage demands, an oil crisis in the 70s. Now we've got a natural gas crisis combined with $84 a barrel oil prices. It's not an oil crisis yet, but in the 70s you had the time when all the Arab states suddenly massively increased the price of oil, which sent the rest of the world into recession, because they'd been used to cheap oil prices. And similar things happening with natural gas now, and that's going to drive some countries into recession and could see a long cold winter. So we're not calling it the oil crisis of the 70s, but we're now calling it the energy crisis. And the energy crisis is threatening to shut down manufacturing, within days in the UK. A lot of big manufacturing companies, steel, ceramics, food production, packaging, paper, they need a lot of power, and they may have to shut down. It could be like the 70s 3-day week, where they have to go on a shorter working week because they haven't got enough power. Yes, the lights went out in the 70s actually. They had a 3-day week because there were power cuts, and people were advised not to go to work more than 3 days a week to preserve power. I think that might have been in a coal miners' strike because most of the power stations were fueled by coal in those days. So we've seen this before. Business leaders want more government help. Of course, they want the government to open the doors to immigration and just let anybody in so they can fill all the labour shortages. But the government doesn't want that. The government wants an end to low-skilled and low-wage migration and wants to build a new high-wage, high-skilled economy. But I think they're going to have to help the energy in the energy crisis. They're going to have to help companies with loans and some sort of package to help them through this. And I think they were announcing something today, or they're talking about announcing something between the Business Secretary, Kwate, and the Rishi Sunak, the Chancellor in the Treasury Department, that they're going to have to put some money behind this to help businesses. Otherwise, businesses could go bust. And we're talking about major companies that employ thousands of people. And it's a shame, really, because, the UK is actually sitting on huge supplies of natural shale gas that they will not mine, they will not frack, called fracking this is, will not frack because the government is worried about environmental concerns. And I understand also that the UK manufacturing companies have to pay a tariff, an environmental tariff. I mean, God's sake, they pay an environmental tariff, which other countries don't just ignore all that. They don't have to worry about it. It puts us at a massive disadvantage to China. China is burning coal like there's no tomorrow. They've got coal-fired power stations guzzling gas out into the sky and emissions that make us. I mean, we only account for, I think, 1% of global emissions in the UK, and yet we're stifling business. We're putting all these rules and regulations on them. They wanted to open a new coal mine in Cumbria, a small coal mine. It was shouted down so much that it looks like it's not going to happen. I hope it does happen. They can find a way of dealing with the emissions. They can have use technology to deal with the emissions, because if not, if we're just relying on natural gas from Russia, then I feel we're in trouble. 15% of our electricity actually comes from France. Now we're in a dispute with France over fishing again. France is already threatening to cut off Jersey's power. And I think they're talking about doing the same to us. They're not happy about the deal we did with Australia because they got cut out of the deal, the AUKUS deal with America and UK and Australia. But that's not really our fault. Why shouldn't we get involved with supplying 21st century submarines and cutting them out of a deal that was going to supply last century diesel submarines? Well, that's not our fault, really. But I think we should look at our energy policy again, get the UK moving, take away all these silly tariffs and that make our industry uncompetitive, and means that employers like Tata Steel closed a good steel factory down, a very efficient steel factory down a few years ago. If you remember, I think it was in not Corby, it was some other city in the north. They closed this factory down. Why? Because of carbon credits. Does anybody even understand what carbon credits are? There was a good workforce there. It was a modern plant producing high quality steel. They had to close down because of environmental issues called carbon credits. So they'll open that in India. They can burn as much coal as they want. And who's going to bother them there? Nobody. So, as I said, China is burning coal like there's no tomorrow. So we've got to get back to being more competitive. Now that we haven't got the European Union breathing down our neck, I'm sure we can do this, but we need to move fast on this. Now, talking of China, their real estate and debt bubble is not over yet. It's not going away. Evergrande and 2 other Chinese property companies have just this week defaulted on a foreign-owned bond payments, bond interest payments. That's billions of dollars of bonds that have been lent to these companies by foreign institutions using maybe some of our money, some of our savings, some of our pension money. And, that if they default, if that doesn't get paid, what will happen then? Will it cause a collapse in that market? I don't know. We'll see. But if it comes down like a domino effect and China goes down, then it's going to bring other countries down with it. I've no doubt. And I reported yesterday that stock markets could fall by 10%. This is a warning from the Bank of England, no less. They feel that financial markets and stock markets could see a sharp downturn as we move into lower expectations of economic recovery from the lockdown. And this is quite serious, because if the stock markets drop and you've got interest rates going up, what then? That is a recipe for a long-term recession. So let's see. How can you protect yourself from a stock market crash or a property crash that could follow a stock market crash? Property moves a bit slower than stocks, but with the stock market crash, it only takes some small event like last year with the lockdown. It just takes a few sell-offs, and then you have these automatic algorithms that start selling things off, and then that the prices will start to tumble. It can happen in a minute, and if you're trying to then sell your stocks, then you're too late. It's gone. It's happened. You wake up and hang on, the stock market's gone down. It's gone. That's it. What do you do? So just protect yourself. Even if you're not directly invested in the stock market, your pension funds, if it's a money purchase type pension fund or a personal pension or a work-based pension, probably is invested in the stock market. So you've just got to be mindful of that and have a word with your manager, your pension fund manager, your administrator, or your financial advisor. Okay, so just check where your money's invested. Is it 80 or 90% exposed to the stock market in a high risk type of situation, or is it maybe 40 or 50% in a medium risk? So just be careful of that, because these fund managers, they get paid a lot of money to invest in funds. Index funds, for instance, already account for somewhere 80% of the money that goes into the stock market, mostly through three large companies, one of them being Vanguard. A bigger one is Blackstone. These are huge companies that invest trillions of dollars on our behalf. Now, that money's in there. It's not their money, is it? It's our money. So they can leave the money in there and not worry. But if you're an individual investor, you have a choice to pull your money out. It's not going to bring the market down if you pull your money out. But I guess if Vanguard sold all of the shares in the stock market that it managed, that would cause a collapse. So they can't move as nimbly as we can. So just check with that. And the real answer here is education, to learn more about invest in yourself, to become more financially aware. And it's the key to building your wealth and keeping your wealth. So never stop learning. That's my advice. Keep watching and listening to my free podcasts on YouTube, my YouTube channel. I'll put a link up to it. And if you're watching on YouTube, then please do like and subscribe to my channel. Really appreciate that, because then it gets out to more people. And similarly with Facebook, please like and share it if you're watching on Facebook. And even on iTunes, if you listen to the podcast on iTunes, you can also share that as well and like it or whatever. It just gets my name out there. So thanks for listening. If you want to take advantage of any of my free training, there's a link there below. Please feel free to click on that and go ahead and take advantage of that. So thanks for listening, and have a great evening. And just get yourself educated, be financially aware. Some of the little tips you can do is just to read a good financial newspaper every day, the Financial Times, the Wall Street Journal. Just glance through the headlines just to know what's going on. I know you should be concentrating more on your own internal economy, but you still need to know what's going on out there and what might affect your economy. You can also find these things on the web. You can looking at say some of the big websites, the financial websites, Bloomberg and that. So you can get a pretty good feel for what's going on out there in the market, so you can anticipate things yourself. And always at the weekend, there's also some good. In the UK, we have the Saturday Telegraph, the Sunday Times, which are good newspapers at the weekend to go through personal money issues, like where to get mortgages, which are the best mortgage rates out there, which are the best deals on loans, which companies are perhaps not providing a good service, all these sorts of things, and it will give tips on pensions, explaining pensions, explaining investments, explaining wills and trusts. I mean, today in one of the newspapers I picked up, there was a section on lifetime mortgages, equity release mortgages. I must do a session on that sometime. So thanks for listening and have a great evening. Thanks for tuning in, for sharing, for liking and subscribing. Thanks a lot. Good to see you.